Secure 2.0 made it possible for new plan sponsors to receive a very large tax credit. This video is all about how to calculate and receive that tax credit.
So if you're looking for your sign, here it is.
The tax credit is for for-profit entities who have not sponsored a plan during the prior 3 years with considerably the same people, and you have to have at least one non-highly compensated employee. What's the easiest way to calculate the tax credit?
Go on our website and calculate the
Right,
credit.
exactly. But if you'd like to have us describe what's going on, we can do that right now. Our website, because this is what the IRS is asking for, is going to ask for how many total employees did you have or do you have that have earned at least $5,000, okay? How many highly compensated employees do you have? Now, a highly compensated employee is somebody who owns more than 5% of the company, somebody who has made more than $135,000 during 2022. The other number we're going to ask you for, because the IRS is asking for it, is how many employees made under $100,000. Now, this can include highly compensated employees who haven't paid themselves very much but own more than 5% of the company. So all those three numbers can be different. The IRS is continuing a tax credit that they started with Secure 1.0 that is available to all employers, okay, that have a 401k plan. Not entirely certain if it applies to 403b plans, okay, because there's that whole not-for-profit thing. But even if you have an existing plan and you've had a plan for a really long time, if you add auto-enrollment to your plan, you're going to get a $500 tax credit for the first 3 years you have that provision in your plan. So everybody's can get something out of this. So what auto-enrollment is, it's not mandatory enrollment. Auto-enrollment means that an employee is by default in the plan at a certain date at a certain rate. Okay, yes, they're supposed to be told about this beforehand. That's all part of the rules, all right? Whereas the old-fashioned way is more of an active enrollment. You as the employer have to hand somebody a form, they fill it out, they return it, then you start taking money out of the paycheck. Auto-enrollment is the opposite. They have to hand you a form saying zero, saying no, don't do that, all right?
So it's the presumptive close.
It's a presumptive close.
So you're joining our 401k plan, aren't you?
You are in our 401k plan
unless
you want to be asocial and leave. Anyways, I don't know if that's appropriate, but you can figure that. Yeah, they just don't want to be in our pool party. Now then, there are three types of tax credits that are available under Secure 2.0. There is the one that we talked about with the auto-enrollment, $500 a year for the first 3 years, even if you had a plan for a while. All right. Then there's an increase of the startup credit that started in Secure 1.0. Okay. And number 3, there's an employer contribution credit for companies starting a defined contribution plan.
Yep.
Pretty good, huh? Okay. So let's say you have under 50 employees total. You have 40 employees who are not highly compensated and who are also making under $100,000, and you're adding auto-enrollment. You as the employer are going to get up to a $45,500 tax credit the first 3 years of the plan. You're making a $1,000 contribution per employee. So if you have 40 employees making under $100,000 and you put in $1,000 in each person's account as a profit sharing contribution, Uncle Sam is going to give you $40,000 back as a tax credit. Now it's $45,500 for the first 2 years because it starts to wear away with year 3. But that's all right, okay? It's still not bad. That's still not bad math, all right? So go check out our calculator. The link is in the description and you can see how much you can save.